at 3:17 a.m., while most of the world was asleep, a quiet decision was made that reshaped millions of lives. No soldiers moved, no buildings collapsed, no alarms sounded. A few people in suits adjusted a number by 0.25%, and within weeks, rent rose. Credit card bills grew heavier. Startups froze hiring, and families postponed buying homes. That's the real power of central banks. Silent, invisible, relentless. And the part they don't like to talk about is how much of this system runs on controlled illusion. Let's start with why this matters right now. Inflation surged. Interest rates spiked faster than at any time in decades. Governments borrowed more than ever. And suddenly, everyone started asking the same question. Who actually decides the value of money? Officially, central banks exist to keep prices stable and economies healthy. That's the mission statement. But the real job is more complicated. They don't control the economy directly. They control behavior. Here's how it works in simple terms. When things overheat, they raise interest rates. Loans become expensive. Spending slows. When things break, they cut rates. Money gets cheaper. People borrow. Businesses expand. That's the lever. Push here, pull there. Try to keep the machine balanced. Sounds clean. In practice, it's messy. Because central banks don't inject money evenly. They don't hand it to workers or small businesses first. New money enters through banks, financial markets, and government bonds. The people closest to those pipes benefit early. Asset prices rise before wages do. Stocks move. Real estate climbs. By the time inflation reaches everyday prices, the advantage is already locked in. That's not conspiracy. That's math. After 2008, central banks created trillions out of nothing. Literally typed new money into existence. It was called quantitative easing. The promise was recovery. The result was the largest asset boom in modern history. The S&P 500 more than quadrupled. Home prices exploded, and wealth inequality widened quietly, steadily, mechanically. Here's the uncomfortable part. Inflation isn't just a mistake, it's a feature. Moderate inflation makes debt easier to repay. Governments love this. When prices rise, the real value of old debt shrinks. You owe the same number of dollars, but those dollars buy less. That's good for borrowers. And governments are the biggest borrowers on earth. So when central banks say they're fighting inflation, what they really mean is they're trying to manage it, not eliminate it, control the speed, control the damage, keep it just painful enough to function without breaking trust. And trust is the real currency. Money only works because people believe it will work tomorrow. Central banks spend enormous effort shaping expectations. Notice how they speak. Carefully chosen words. Transitory, data-dependent, soft landing. These aren't technical terms, they're psychological tools. Because markets move faster on belief than on reality. If traders think rates will fall, prices move today. If consumers fear inflation, they spend faster, making inflation worse. So central banks perform a strange balancing act, telling the truth without triggering panic. Sometimes they fail. In 2020, rates went near zero. Money flooded the system. Stimulus checks, cheap loans, asset bubbles everywhere. Then inflation exploded. Suddenly, the same institutions that encouraged borrowing slammed on the brakes. Rates jumped, mortgages doubled, tech companies collapsed, layoffs spread. The irony is brutal. The medicine that saved the patient created the next illness. And here's the deeper secret. Central banks don't have perfect control. They react more than they lead. By the time inflation shows up in official data, the damage is already baked in. By the time recessions are confirmed,
Businesses have already cut jobs. The system runs on lag, always late, always catching up. Which means ordinary people absorb the shock first. Higher food prices, higher rent, higher debt payments. Meanwhile, financial institutions hedge, reposition, adapt. They have speed, access, tools. The gap widens again. Zoom out, and it gets more uncomfortable. Global debt is now so large that truly high interest rates would collapse governments. So central banks are trapped. Raise rates too much and break the system. Keep them too low and destroy purchasing power. There is no painless option, only trade-offs, quiet ones. This is why central banks rarely talk about the end game, because there isn't one. There is only maintenance. Patch the system, stabilize today, push the consequences forward. And that brings us to the real question. If money is managed by small groups making decisions behind closed doors, if inflation is partially intentional, if debt depends on controlled erosion of value, and if trust is held together by carefully chosen words, then what exactly are we building towards? A more stable future? Or just a longer version of the same fragile cycle? Because the next rate decision isn't just a number, it's a signal. And whether you realize it or not, your life will move with it.